Our next presenter is Anfield Energy, and presenting on behalf of the company is President and CEO Corey Diaz. Corey, go ahead.
Great. Thanks, Derek. Good morning, everybody. Thank you for joining the call. As Derek mentioned, we're called Anfield Energy. We are an emerging U.S. uranium production company. The vast majority of our assets are in the United States, and I'll walk you through our plans for the near term. Safe harbor, please read at your leisure. Page 3, reasons to invest. We've got assets in the premier mining jurisdictions in the U.S., including Wyoming and Utah. We do hold a portfolio of 25 ISR properties in Wyoming. The crown jewel in our portfolio is the Charlie ISR project. This asset sits in Wyoming. It's an ISR project. On either side of it sits Uranium One's existing mines. We do have a PEA for this project, which was released about a year ago. And we also have an agreement in place with Uranium One to use its existing processing facility. So in terms of the cost to move forward to production, it's relatively low, just under $7 million with production of 200,000 pounds plus per year. On the other side of our business, the hard rock side of our business, which is more of a blue sky opportunity, probably unlikely to be realized in the current uranium cycle. We do have the Shootaring Canyon mill. That's one of 3 mills in existence in the U.S., conventional mills in the U.S., with about 1 million pounds of production capacity available to it. But our focus in the near term is ISR and specifically Charlie, because we know that Charlie would be relevant in the current uranium cycle. The projects that we do hold include low permitting risk, low capital costs, as I mentioned, the optionality tied to Utah and the hard rock assets. We do have a management team and board which has more than 75 years of uranium-related experience. And the other thing that we've looked at, given where we are in the market, the potential of looking at other cash flowing opportunities, whether it's in this market or in other commodities, but following the same pattern of near-term production. Our strategy, we're looking to build a company which can present cash flow in the next, call it 2 to 3 years, whether that's internal growth or looking to acquire from elsewhere. Our focus, as I mentioned, is ISR. ISR is the part of the market which will realize production at a lower price than hard rock in the nearer term. So our focus is there, and specifically Charlie, as I mentioned. The blue sky in our portfolio remains the hard rock assets. These are assets which, if the price does move significantly, perhaps they can be realized and used in the current cycle. But, our focus, as I mentioned, is ISR in the near term because, we believe that those assets will be amenable to the current cycle. So the near-term industry catalyst, which is, more significant to U.S. players, is the U.S. Uranium Reserve. If you recall, back in January, the U.S. government put out its fiscal 2021 budget, which included the creation of a federal uranium reserve and had requested $1.5 billion over the next 10 years to acquire uranium from U.S. players. There are only a handful of uranium producers or near producers in the U.S. who could potentially participate in this uranium reserve, contribute to and participate in this uranium reserve, and Anfield is one of those companies because of the Charlie project and the low cost and the quick turnaround to production inherited with that asset. The government, has also said that we're looking to find a number of other steps to revive the uranium industry. I guess the one issue here is that obviously the government may be changing in the next couple of weeks. Right now, we know that the Democrats also support the nuclear industry. The big question is whether or not it will support the Federal Uranium Reserve as it stands. No funding has been provided for the Uranium Reserve as of yet, and perhaps under a Biden administration it will be funded. We're uncertain at this point. I think there was a lot of expectation that there would have been funding taking place this year for the Uranium Reserve, but that never came to pass. So there was a little bit of uncertainty tied to the Uranium Reserve. That said, we do know that the supply-demand imbalance worldwide when it comes to uranium is certainly there's a big split And we think that at some point in the next 12 months, the U.S. utilities will be going back to the market to start contracting again. We know that Cameco and Kazatomprom have put their thumbs on the scale to make sure that this takes place sooner rather than later, with the reduction or elimination of production for a period of a few months in order to help move the uranium price back up. So we would expect to see some kind of movement in the next 12 months. Capital markets profile, we can see that we trade on the Venture, the QB, and the Frankfurt Exchange. We're sitting close to our 52-week low. A lot of that probably tied to the fact that there's uncertainty in the marketplace tied to uranium. We do have about 130 million shares outstanding. Our largest shareholder is Cotter Corporation, from whom we acquired the Charlie asset along with the West Slope assets, which are vanadium-rich assets in Colorado. I'll mention those a little bit later. Research coverage comes from Derek and Red Cloud. Management directors, I'm on the top of the list here. Former research analyst, fund manager, strategy consultant with CIBC, Fortress Investment Group, and Monitor Group. I've been running the company for about 7 years now. We've been focused on uranium for the most part. We did dabble in copper at the beginning, but the copper price moved against us, so we pivoted to uranium. But we are familiar with obviously that type of commodity. And that's always something that we make sure that we have, our ears to the ground when it comes to potential cash flowing opportunities in other sectors. Scott Lumadou has worked for a number of years in the nuclear industry, almost 40 years. Josh Bleak has spent, he's our man on the ground in the U.S., helps us to find us assets and look at other opportunities, not only in uranium, but in other places. Don Falconer has run both private and public companies in the uranium sector and has worked for Ontario Hydro in the nuclear division. Stephen Lunford has a lot of Wyoming-related ISR experience and even specific experience tied to the Charlie project. And John Eckersley has worked for publicly traded companies, and he's our in-house counsel. So our steps to uranium production. So as I mentioned, our focus is on Charlie because we believe this is the asset that will ride out the current uranium cycle. $6.7 million based on our PEA in order to move that forward to production. And tied to the resin capture and processing agreement we signed with Uranium One a few months ago, allows us to produce 500,000 pounds per year at its existing facility. In terms of future assets, some of the other ISR assets tied to our transaction with Uranium One a few years ago, the 24 projects, those are projects which we believe will serve a purpose probably in the future. Some of those may fall into the current uranium cycle, but given the cycles tend to be roughly 10 years, some of these, the vast majority will probably fall outside of the current cycle. That said, any that do fall inside the cycle will be available to us through the resin capture and processing agreement. Once again, we can leverage the same agreement that we used for Charlie on these projects in order to start producing. So these are certainly the near-term opportunities for the company, primarily Charlie, and then secondarily the other ISR projects we hold. And then the blue sky in our portfolio is related to our hard rock assets. At the conventional mill at Shootering in Utah, one of only 3 licensed and permitted constructed mills in the U.S. That said, the price that you'd have to have in terms of the uranium price is more than double where it sits today in order to justify looking to turn that mill on. So the way that uranium works in terms of production, ISR is a cheaper way to move into production. So you would be looking at more than probably an increase of $10 to $15 above where ISR becomes viable in order to turn on the mill. But certainly if the price does move to the point where we're seeing $60 to $70 or $80, then the mill would come into play and it would add significant capacity to our portfolio. But as I mentioned, we've had some time to prioritize our asset base, our asset portfolio, and it's clear that ISR is our near-term focus. So here's a map showing some of our key assets. We do have a small asset up in Saskatchewan, which we acquired as part of an investment related to some of our previous investors who've sunk money into the company. But the U.S. is where we're focused. You can see that the gray dots represent our ISR projects up in Wyoming, whereas the blue dots represent our hard rock assets in Utah, Colorado, and Arizona. Those are our secondary assets, and as I mentioned, the ISR assets are our primary assets. Skip on, sorry. And Charlie, we've talked about Charlie before, but we acquired this asset in March 2019 from Cotter Corporation. The production timeline to reach significant production is about 24 months due to the proximity of this mine to two Uranium One's existing properties. Essentially, we have to build a pipeline from our mine to Uranium One's existing satellite plant, so that's why the cost is relatively low. We do have the agreement in place with Uranium One to help us with processing. We also have an agreement with Uranium One to allow us to leverage our expertise when it comes to wellfield development. So we do have a significant opportunity just working with Uranium One itself. There's an exploration target tied to the property. Right now, there's about 4.1 million pounds of measured and indicated and inferred resource, but we could certainly grow the resource by anywhere between 400 and 800,000 pounds. The PEA called for about a $19 million NPV based on an 8% discount rate and $65 price. Pre-production capex, as I mentioned, is $6.7 million, and direct OPEX at $23 a pound, which is relatively cheap. Our all-in cost is about $35 to $36. So, given where the term price is today of about $35, we're essentially at break even, including all the pre-production capital. So our future assets, as I mentioned, we do have a portfolio of ISR projects, some of which may play a role in the current uranium cycle, but we do have plenty that we could essentially look to, partner with other players in the current market in order to move forward to production. But we do have 24 projects that we picked up from Uranium One a number of years ago, along with significant database of drilling. And you can see that we have put some resource, we've updated some resource for some of these projects, to add to our portfolio. We can continue to do that. So another Blue Sky project, the hard rock asset in Velvet Wood. So we purchased this from Uranium One back in 2015. There was production on this asset a number of years back, 4 million pounds of uranium, 5 million pounds of vanadium, so there is vanadium available to us here too. There is the NPV for the project is about $63 million with cash costs of about $29 a pound. But once again, we'd be looking at prices, in the 60s in order to, bring the mill up for, get a production ready and then have the ability to put this through the mill. This would be the first feed into the mill if we were to move in that direction. Whether or not this fits into the current uranium cycle is the question. But certainly, if there's a sustained production cycle, this could become a very relevant project. And here shows a few more of our hard rock assets. We talked about the mill. We do have the Frank M deposit, which sits right next to the mill. The West Slope project, which came along with the Charlie project through our acquisition of those assets from Cotter Corporation. They're vanadium-rich projects in Colorado. Historic resource, including 11 million pounds of uranium and 53 million pounds of vanadium. Means that there's certainly an opportunity for us to create a longer life of mill tied to sheetering. The other alternative is to look to partner with an existing mill in order to move these assets forward. There are the Finley tank pressure pipes in Arizona, a different type of mining. These came with a transaction that we closed with Uranium One a number of years ago. It's not something that we're focused on today. It's a different type of mining. And then the royalties tied to the assets of other uranium players in the market, 3 other players in the market, including Western Uranium, Zarga, and Energy Fuels. So peer comparison, you can see that despite our portfolio, we do trade at a significant discount to our peers. Some of that is related to the fact that we're not that well known, but I think part of it too is that we do have some obligations to Uranium One, which are weighing down our prospects in the near term. That said, we do believe that there is a significant opportunity for us to at least reach the average the average level of our peers, which means that given where we're trading today, there's significant upside tied to the company as we move forward and execute, especially on an asset like Charlie. So in summary, Anfield is a company that is looking to move towards production in the relative near term. Our focus, once again, is a Charlie project, which has a very low upfront cost prior to production. And it does have a resin capture processing agreement in place with an existing facility. So production is relatively straightforward. The one thing that we'll need is that the uranium price, does start to move in the right direction, because we're sitting at roughly cash flow neutral at the moment. That said, we do have other opportunities, in this cycle potentially, but certainly in future cycles tied to both ISR and hard rock. Once again, we are waiting on the uranium price to move in the right direction for those to be realized. But I think the way that the uranium market is moving in terms of the uranium reserve, the supply-demand imbalance, the actions of the larger players in the market, to facilitate an upward swing in the uranium price, bodes well for the company. And I think the next 12 months will be pivotal. So I think at the end of the day, we're going to be looking at cash flow positive opportunities within the uranium sector, along with potentially other sectors where opportunities may lie. Thank you for your time. Derek?
Thanks, Corey. I think that's a great overview of the company and a good summary. One thing that caught my eye in the presentation is the uranium royalties that you have. Are those, I guess, two questions that go with that. Are those, one, cash flowing? And, are you looking at opportunities to monetize those to potentially, with, say, a uranium royalty company that exists, to bring in some money to help move ahead, help fund maybe early construction on Charlie or anything like that?
Sure. Yeah. So Eric, Derek, those are non-performing royalties at the moment. And they're tied, primarily to hard rock assets. So, as I mentioned during the presentation, hard rock is not likely to be the first source of uranium in the relative near term. But there's certainly opportunities to look at, monetizing, should we decide to move in that direction. But I do believe that, our portfolio does have an interesting mix of assets. But we do, for the most part, we're so focused on, getting our projects move forward that, if there's value, if we see there's real value there, and if somebody else sees that there's real value there, we have to weigh, the near-term gain from, kind of a one-off sale versus holding on to those, till, this cycle or another cycle does provide, real value. So we're not, we're not married to any of our assets. But we'd certainly entertain opportunities should there be some.
And then, obviously Charlie is located in Wyoming, and there's been some developments. Obviously, Wyoming has a long history of ISR production. Maybe talk a little bit about Wyoming as a jurisdiction in the last minute here that we have.
Sure. So, Wyoming is one of the leading uranium producing states and has been for a number of years. There are a number of products, most of the junior companies that are operating today and are looking to move to production are actually sitting in Wyoming, because it's, you've got a great jurisdiction. You've got, a state which is amenable to production and understands production and understands, the needs of producers. So facilitates, production very, very well. So, from our perspective, moving forward on that asset and knowing that, both, Uranium One has produced and, has been producing relatively recently in the state, at the same facilities where we'll be producing, gives us a great deal of comfort. And I think that that's why most people who are looking to get into production in the near term are focused on Wyoming.
Right. Excellent. Thank you. Thank you, Corey. That was a great update and good answers to the questions. Thank you, everyone, for attending the Anfield Energy presentation.